Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Vanda Pharmaceuticals.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps us out.
Absolutely.
So getting right into it today, I was looking at the charts this morning, specifically the price action around mid-February, and honestly, it just looks like a crime scene.
Yeah, it is definitely not for the faint of heart right now.
I mean, we're talking about a stock that absolutely nosedived, down almost 10% immediately after they released their Q4 earnings on February 11th.
Right.
And, if you're just a casual observer, or maybe you hold the stock and you see that alert pop up on your phone, your first instinct is probably, okay, something is fundamentally broken here. Time to abandon ship.
Which is the headline reaction. And frankly, that's the algorithmic reaction too. But this is exactly why we do these deep-level analyses.
Yeah.
Because if you just stop at that 10% drop, you are missing one of the most interesting paradoxes in the biotech market right now.
A paradox. Okay, you're going to have to sell me on that. Because a 10% drop usually implies the market sniffed out a rat, right?
You'd think so.
Yeah.
But it's a complete disconnect between market sentiment and the actual fundamentals.
Yeah.
The market punished them for a guidance missed, which we definitely need to pick apart.
Yeah.
But under the hood.
Yeah.
The actual business,
Yeah.
specifically their revenue engine,
Yeah.
is accelerating at a pace we just haven't seen from them in years.
Okay, let's unpack accelerating, because usually when a stock drops off a cliff like that, it's because sales are tanking or a trial failed. You're saying the data says otherwise.
Completely the opposite.
Yeah.
Let's look at the full year 2025. Total revenue hit $216.1 million.
Okay.
That is up 9% year over year. But the real story, the wealth signal as we like to call it, is their flagship drug.
Fanapt.
Fanapt, that's their schizophrenia treatment. Right, it's been around for a while.
It has, and that's exactly what makes this so strange. Normally, with an older drug, you expect a slow decline, or maybe just flat sales if they're lucky.
But net product sales for Fanapt didn't just grow, they surged. We are talking a 24% increase to $117.3 million.
Wait, 24% growth for a legacy drug? That is not typical behavior at all.
No, it's not.
Is this just price hikes? Like, did they just decide to charge 20% more per pill?
That is the very first question you should ask. But no, this is volume driven. If you look at the prescription data, which is really the heartbeat of any pharma company,
Right.
new to brand prescriptions are up 149%.
Hang on. 149%.
Yes.
So they have effectively, more than double, almost tripled the number of new patients starting on the drug.
Exactly. And total prescriptions grew 28% overall.
Okay, I really need to wrap my head around this. You have a core product that is effectively exploding in popularity. New prescriptions up 149%. And yet the stock price plunges. The math just doesn't add up. Why did the market panic?
It comes down to the classic battle of expectations versus reality, and specifically future guidance. Wall Street hates uncertainty, and they hate it even more when a company says, hey, next year might be a little lighter than you modeled.
Ah, the dreaded guidance miss.
Precisely. The analysts, the people whose entire job it is to predict these things, they were modeling 2026 revenue to come in around $271.3 million.
Okay.
But when the company released their numbers, they guided for a range of $230 to $260 million.
I see. So even if they hit the absolute top of their own projection, they were still $10 million short of what the street wanted.
Correct. And in this market environment, algorithms are programmed to shoot first and ask questions later. If the guidance number is lower than consensus, it triggers a sell order. It doesn't matter if prescriptions are up 149%. The model says sell, so the price drops.
Wow. But that wasn't the only scary number I saw in the report, and I want to push back on this everything is fine narrative just a bit.
Fair enough.
We have to talk about the net loss. I saw a reported GAAP net loss for 2025 of $220.5 million.
It is a big number.
It's a massive number. The previous year, the loss was only $18 million, so they went from losing $18 million to losing $220 million. I'm no forensic accountant, but that looks like a massive hole in the boat. How do you explain that away?
It looks absolutely terrifying on paper, I agree. Widening from 18 to 220 million sounds like a catastrophe. But this is where we have to put on our reading glasses and actually look at the footnotes.
Okay, enlighten me.
You have to distinguish between actually losing money and accounting adjustments.
Translate that for me. What's the adjustment here?
Over half of that loss, $113.7 million of it, was a one-time, non-cash income tax charge.
Non-cash, meaning they didn't actually write a check to the IRS for $113 million.
No, not a single actual dollar left their bank account for that. It's what's called a valuation allowance against deferred tax assets.
Okay, that is a mouthful of pure jargon. Break that down for us. Like, explain it like I'm 5.
Sure. Think of deferred tax assets, like a stack of coupons you have sitting in a drawer. These coupons let you pay less in taxes in the future because you lost some money in the past.
Okay, follow.
But accounting rules say, if you aren't absolutely sure you'll make enough taxable profit to use those coupons soon, you have to pretend they are worthless today.
So you basically write down the value of the coupons to 0.
Exactly. You take a charge on paper saying, we might not use these coupons. It drastically reduces your reported net income, but it doesn't touch your bank account. It doesn't affect their ability to pay salaries, launch drugs, or keep the lights on.
Interesting. So if you strip out that coupon right down.
If you strip that out, what you see is a company that is spending money, yes, but they are spending it on R&D and commercial infrastructure. They are spending money to get that 149% growth in prescriptions we just talked about.
So it's a calculated investment, not a cash bonfire. Okay, that makes me feel a little better. It's an accounting quirk, not a bankruptcy filing. But let's check the safety net anyway, because even if the loss is accounting magic, they still need actual cash to operate while they grow. Do they have the runway?
They do. They are sitting on $263.8 million in cash and equivalents. That is a fortress balance sheet for a company of this size.
That's actually more than their total annual revenue.
Right. It gives them a clear runway through 2026 and well into 2027. Plus, they filed a mixed shelf prospectus recently on February 12th.
Now, usually when I hear shelf prospectus, I think dilution. I think they are getting ready to print more stock and lower the value of my shares. Is that what's happening?
It's always a possibility, but in this specific context, it's standard housekeeping. It basically means they are setting up the paperwork to raise money if they need to, without any regulatory delay.
Just having options open.
Exactly. It signals proactive capital management. They aren't desperate today. They are preparing for growth. They want to ensure they have the ammo to support their pipeline if a new opportunity pops up or a trial succeeds.
Okay, so we've established that the panic was maybe a bit overblown, driven by a guidance miss and a really confusing tax bill. But let's go back to Fanapt. You mentioned it grew 24%. My main concern is this just a short-term pop, like a blip on the radar?
This brings us to what I think is the most underappreciated part of this entire story, the competitive moat.
I love a good moat. But usually with small-cap biotech, the moat is filled with alligators. And the alligators are generic drug companies just waiting to eat your lunch.
Right, the dreaded patent cliff. Usually you look at a drug that's been out for a while and you think, okay, generics will come in 2 years, revenue goes to 0.
Exactly. Everyone is sweating that expiration date.
Well, Fanapt has patent protection until 2044.
Wait, sorry, did you say 2044?
2044.
That's almost 20 years from now. That sounds impossible. Most patents are 20 years from the date of filing, and by the time the drug actually hits the market, you have maybe 7 or 10 years left. How do they have until 2044?
It's a highly unique situation involving new formulations and method of use patents that they have successfully defended. It is practically unheard of in this sector. But think about what that does to the valuation model. It creates immense terminal value.
Terminal value meaning the cash flow isn't stopping anytime soon.
Right. It means that every single dollar they spend on marketing now, every new doctor they convince to prescribe Fanapt today, is generating a revenue stream that could last for 2 decades.
Wow.
They aren't renting this market share, they own it for a generation.
That changes the math completely. It's not just a trade anymore, it's a franchise.
Exactly. And that explains all the current spending. They launched a massive direct-to-consumer campaign in Q1 2025. That's why you're seeing that huge spike in brand awareness and prescriptions. They are building a long-term asset because they know they actually have the time to harvest it.
Incredible. So, you have a solid foundation. But let's be real, the stock market is impatient. Traders do not care about 2044. They care about next week. And looking at the calendar, things are getting incredibly spicy right now.
Spicy is an understatement. We are right in the middle of a cliffhanger moment.
I'm referring to the trading activity, or really the lack thereof, on February 20th. The stock was halted. Twice, marked as news pending. Now, for the uninitiated, getting halted isn't always a good thing. Sometimes it means you're about to get sued or investigated.
True. But for anyone who follows biotech, you know exactly what this means when it aligns with a specific date on the regulatory calendar.
February 21st, the PDUFA date.
Right, PDUFA. the Prescription Drug User Fee Act. Basically, it's the strict deadline the FDA sets for itself to say yes or no to a new drug application. The drug in question here is Bysanti, or milsaperidone.
So the halts on the 20th were basically a calm before the storm, the FDA decision regarding Bysanti.
Correct. This is a binary catalyst. It's the Super Bowl for this specific drug. Either they get the green light or they get a rejection letter. There's no in between.
And the stakes are huge. But here's where it gets really interesting for an investor looking at risk. You mentioned earlier that the stock had already sold off 10% on the earnings news just a week prior.
Right. And that is absolutely key to the thesis. We call this asymmetric risk.
Explain that concept for us.
Think of a coin toss. Heads, you win $100. Tails, you lose $5. You would take that bet all day long, right?
Absolutely.
That's the situation we're looking at here. Because the stock was already beaten down by the earnings miss, because the market was already grumpy, a lot of the downside was arguably already priced in.
Got it.
The people who were going to panic sell had already sold. We were in a capitulation phase.
The weak hands had already folded.
Exactly. So if the FDA news is bad, the stock might drop a bit more, sure. But if the news is good, if Bysanti gets approved, you have a coiled spring.
Because nobody was expecting it. Or at least the current price didn't reflect any optimism at all.
Precisely. And Bysanti isn't just another generic drug.
Right.
It expands their entire psychiatry franchise beyond just schizophrenia. And there is a clear roadmap to expand it even further into major depressive disorder later in 2026.
Oh, wow. So an approval for Bysanti isn't just one win. It unlocks a whole new level of the game for them.
It completely validates their pipeline. It tells the market, hey, we aren't just the Fanapt company. We can execute on new science and get it across the finish line.
Speaking of new science, I want to pivot to something that I think is completely flying under the radar. We've talked Fanapt, we've talked Bysanti, but in the research, I found something called Nereus.
Ah, yes. The hidden gem.
Now, on the surface, Nereus is a drug for motion-induced vomiting, seasickness, car sickness, which, okay, fine, there's a market for that, people go on cruises. But you found a connection here that genuinely blew my mind.
It's the smart wealth angle. You always have to look at where the broader market is moving. What is the single biggest trend in pharma right now?
Weight loss, GLP-1s, Ozempic, Wegovy, Mounjaro. It is literally all anyone talks about.
Correct. It's a modern-day gold rush. But what is the number one complaint? What is the number one side effect that makes people stop taking those drugs even when they are successfully losing weight?
Nausea, vomiting, gastroparesis. It's brutal.
Exactly. It makes people feel absolutely terrible. Well, the company is planning a phase 3 program for Nereus, specifically targeting Wegovy-induced nausea.
That is actually kind of genius.
It's a massive, massive opportunity. We aren't just talking about people on cruise ships anymore. We're talking about tens of millions of people taking GLP-1 agonists for weight loss every single week.
So if Nereus can become the standard of care add-on, like you take your Wegovy shot and you take a Nereus pill to handle the side effects so you don't feel sick.
You are drafting off the success of the biggest drugs in pharmaceutical history. It turns what looks like a niche product into a high-volume blockbuster opportunity.
It's basically a call option on the obesity epidemic.
And the market is barely assigning any value to this yet. They're looking at it on paper as just a motion sickness pill.
That is fascinating, truly. And they have one more iron in the fire, right? Imsidolimab.
Yes, submitted in Q4 2025. That one is for generalized pustular psoriasis. It's a rare orphan disease.
Now, orphan disease usually means a very small market, though. Why should we care about that one?
Small patient population, yes, but very high pricing power. Because there are no other effective treatments, insurers will pay a premium. It's a classic high-value, low-volume play. It's just another shot on goal that diversifies their revenue mix.
So let's zoom out for a second. We've got the growth engine in Fanapt with a shocking 20-year runway. We've got the immediate drama of the Bysanti FDA decision. We've got the hidden potential of Nereus and the GLP-1 connection.
Right.
But we have to talk price. Is the stock actually expensive right now?
This is the final piece of the puzzle, the valuation. After the recent sell-off, it is trading at roughly 1.4 times sales.
1.4 times sales, that sounds, incredibly low.
It is dirt cheap. For context, the average biotech company with commercial products trades at somewhere between 2.5 to 3.0 times sales. Some of the high-growth ones trade at 5 or 6 times.
So they are trading at literally half the valuation of their average competitors.
Basically. And remember, those competitors often don't have a product growing at 24% with patent protection until 2044.
It feels like the market is pricing them as if they are going out of business tomorrow.
Or at least pricing them as if management is totally incompetent. There's definitely a show-me penalty being applied here. The market is effectively saying, we don't believe your guidance, and we really don't like your confusing tax bill.
But the cash balance and the actual sales growth argue that the business is much healthier than the stock price suggests.
That's why the bullish thesis stands at a 7.5 out of 10. It is a high-risk, high-reward setup. You have a solid baseline, the floor is Fanapt, and the massive cash pile. You have a fortress balance sheet. And you have three major catalysts, Bysanti, Nereus, and Imsidolimab, that could drive the stock significantly higher.
Right.
The recent sell-off just gave you a discount entry point.
It's like finding a custom designer suit on the clearance rack just because it has a smudge on the plastic packaging. The suit is totally fine. The market is just distracted by the smudge.
That's a great way to put it. The smudge was the guidance miss and the tax charge. The suit is the 20-year patent and the accelerating sales.
So what does this all mean for you listening right now? If you're looking at your portfolio, what is the move?
It means you need to be watching the outcome of those February 20th halts and the Bysanti decision very, very closely. That is the immediate domino that needs to fall.
If that news is good, the repricing could be violent in a good way.
Exactly. But even looking past that immediate binary event, the long-term story is simply about execution. Can they keep growing Fanapt? Can they launch Nereus successfully into the GLP-1 market? If they do, 1.4 times sales is going to look like a historic mistake by the market.
A historic mistake. I love that. It's rare you get to see a company with this much bad news priced in that actually has this much fundamentally good news happening in the background.
It's a complex story, but those are usually the most profitable ones if you have the patience to really understand them.
Absolutely. And it leaves you with a really provocative thought. If they execute on this GLP-1 add-on for Nereus, and they have a patent until 2044 at 1.4 times sales, how long until a big pharma player just swoops in and buys the whole company?
That is the multi-million-dollar question.
Well, that is a lot to chew on. A company with exploding product sales, a 20-year patent runway, completely disguised by a confusing tax charge and a minor guidance miss. Vanda Pharmaceuticals is definitely one to watch this week.
Absolutely. The next few days will define their entire year.
If you found our talks useful, please consider subscribe, like, and comment underneath. We'd love to hear your take. Are you buying the dip, or is the guidance miss just too scary for you? Let us know. Thanks for listening to Smart Wealth with Joshua.
See you next time.